Let's go ahead and talk about sale-leaseback transactions. As the name suggests, a sale-leaseback occurs when a company sells an asset and immediately leases it back. Depending on the particulars of the transaction, the economic substance might more appropriately be viewed as a secured borrowing transaction rather than as an actual sale. For example, assume a company has a machine with a book value of $900 and a fair value of $1,200. The asset has a 3-year remaining useful life. The company sells it for its fair value of $1,200 and immediately leases it back for 3 years at $482.54 per year, payable at the end of each year. Now, the company is going to receive $1,200. They're going to repay $482.54 per year for 3 years, or about $1,400. In this case, the firm has continued to enjoy the benefits of ownership of the asset for the remainder of its expected useful life. And again, they've received $1,200, which they're going to have to pay back with interest over the next 3 years. In terms of economic substance, this looks much more like a secured borrowing, where title to the asset is being used as collateral rather than as an actual sale. Since the economic substance of this transaction is that it is not a sale, we will have some special accounting rules. More specifically, we will not want to recognize a gain on the sale of the asset, if one exists, since the earnings process has not been complete. If there was a loss on the sale of the asset, we would record the loss in the usual fashion and record the lease in the usual fashion. If there was a gain on the sale of the asset, if it's what's called a minor leaseback, we'll go ahead and recognize the gain right away and account for the lease in the usual fashion. Now, a minor leaseback is one where the present value of the minimum lease payments is less than 10% of the asset's fair value. An example of this might be the case where you have an asset with a 3-year remaining useful life, you sell it, but then lease it back for just 1 or 2 weeks because you need to finish up a certain project you're working on. In this case, most of the risks and rewards of ownership have been transferred to the buyer. You're just using it for a slight lengthening of the original time. If it's a major leaseback, we will defer the gain and recognize it over the term of the lease as an adjustment to depreciation expense. Again, with the example we started with, we have an asset with a book value of $900, a fair value of $1,200, 3-year remaining useful life with no expected salvage value. The company sells it for $1,200 and immediately leases it back for 3 years at $482.54 per year, payable at the end of each year. And at the end of the lease, let's assume that title to the asset reverts to the seller/lessee. The annual payment was computed using a 10% discount rate, so that's the rate we're going to use. And when we sell this asset, we'll record the sale in the usual fashion, except rather than recognizing the $300 gain on sale, we're going to go ahead and call that a deferred gain and put it on the balance sheet. We lease the asset back and we record the lease in the usual fashion, leased asset and lease obligation at the present value of the minimum lease payments. At the end of the year, we record the lease payment in the usual fashion. We write a check for $1,200 and we split it between interest and principal. Next, we record our depreciation expense, and again, we have a $1,200 leased asset being depreciated over 3 years. Now, think of the original data for this example. The asset had a book value of $900 and a 3-year remaining useful life. Assuming straight line depreciation, that means that they would have taken $300 of depreciation expense over the course of 3 years. Because of this sale-leaseback transaction, we're taking $400 of depreciation expense. We're going to go ahead and recognize a portion of that gain, not by crediting gain on sale, but by crediting depreciation expense. So we're recognizing the gain by reducing depreciation expense to the level it would have been had the sale not taken place. The net result of this is that as far as the depreciation expense is concerned, it appears as though the asset had never been sold. We simply have a lease obligation, a liability, and we're paying that off over 3 years. So again, we've made this appear more in line with a secured borrowing transaction.